In January, gold touched an all-time record high of $5,500 an ounce. By July, it was in a freefall. This chart tracks a 16% plunge in the second quarter that broke through the $4,000 psychological floor, gold's worst quarterly performance since 2013. Retail investors panicked. As the price dipped below $4,000, average traders liquidated their holdings, convinced the multi-year rally had reached its end. Yet, while the world's largest financial institutions were doing the opposite. Goldman Sachs, UBS, and JPMorgan began issuing targets for new record-breaking highs. This divergence suggests the smart money saw something in the crash that retail missed, a specific economic trigger that changed the math of the entire market. The source of the panic was the Federal Reserve. Under new chairman Kevin Warsh, the Fed signaled a hawkish shift, intending to hike interest rates to curb energy-driven inflation. Higher rates change the opportunity cost of holding gold. Because gold is a static asset that pays no interest, it struggles to compete with U.S. Treasury bonds when those bonds start offering significant yields. As the Fed signaled aggressive hikes, institutional capital moved out of non-yielding assets and into the U.S. dollar and government debt, seeking those higher returns. The 16% drop in gold price reflected a market pricing in the fear of these rate hikes, rather than a change in the underlying value of the metal itself. However, the Fed's ability to raise rates depends on a resilient economy. Last week, Wall Street got the specific data point they were waiting for, the June U.S. jobs report. The forecast called for 110,000 new positions. The actual report showed only 57,000, a massive miss that suggests the U.S. labor market is cooling much faster than anticipated. This creates a dilemma for the Federal Reserve's dual mandate. They are required to keep prices stable while also maintaining maximum employment. With job growth stalled at 57,000, any further rate hikes to fight inflation now carry the direct risk of triggering a deep recession and breaking the labor market. The market reaction was immediate. U.S. Treasury yields dropped as investors realized the Fed's path for rate hikes had just been blocked. Gold instantly snapped a 4-week losing streak, climbing 2%. The weak jobs data effectively called Kevin Warsh's bluff. The Fed is now in a position where they cannot easily raise rates without risking an economic hard landing. With the threat of aggressive rate hikes fading, Goldman Sachs is targeting $4,900 by year-end, while UBS sees a rally toward $5,200. JPMorgan's long-term forecast is even more aggressive, projecting $6,000 an ounce by late 2026. This target is based on the scale of the global debt bubble, which has now reached $353 trillion. In a world this heavily leveraged, high interest rates act as a weight that the economy cannot carry for long. When the Fed is forced to stop hiking to prevent a debt collapse, the relative value of the U.S. dollar weakens, making hard assets like gold the primary hedge. The second quarter crash provided an entry point for those betting that the current financial system is reaching its limit. Wall Street is moving back into hard money. Do you agree with the $6,000 thesis? Or does the U.S. economy have more room to run? Let me know in the comments.